I'm joined by John Wells, chairman of Leadenhall Capital Partners. His fund specializes in providing insurance-linked investments, and I'm pleased to say that he joins me in the studio now. John, thank you very much indeed for taking the time to come in. So tell me, what is behind the growing interest from investors in catastrophe bonds?
I think that the main interest has come from investors looking for a diversified source of income for their portfolios, and things that don't have correlation to fixed income and equity markets. Also, our investments are on a floating rate basis, so there's no exposure to interest rates, and therefore there's a slight hedge against inflationary expectations as well.
Okay, so just to get into the specifics, you've got US hurricane season going on now, so that's an example of a period of what it's going to be a lot of activity for you. You're going to be very busy. You update your clients on how things are progressing.
Sure.
And what is that? What are you saying to them?
Well, essentially what happens most of the time is we've built our portfolios which have got a range of different risks. Sometimes we'll have US hurricane risk mixed with US earthquake risk, European risk. So it's not only the hurricane season that we're sort of concerned about. And also, most of our investments are only going to be triggered and lose money if there's a very extreme event. So Hurricane Katrina would cause us some concerns, but smaller hurricanes that don't do a lot of insurance damage wouldn't cost us money, and therefore our investors money.
So you need something sort of moderately bad to happen, so to speak, you know, in order to make money. But if something extreme happens, like Hurricane Katrina, then you're exposed and you lose. That's
right. Essentially, what is the best market for us is essentially what's happening right now. In the first half of this year, there have been about $60 billion worth of insurance and reinsurance claims from these kind of natural catastrophes. That's meant that rates have tended to go up, but because there haven't been any significant losses for us from any of these disasters, it means that we've made money for our investors, and rates are going to go up, which means that we'll make more money for our investors, assuming that nothing significant happens in the hurricane season. Yeah, and just to clarify this, you have to differentiate between different types of risk, of course, because, you know, there's the US hurricane season, which can be forecasted, events can be predicted to a certain extent, and then you have random, unprecedented catastrophes like the Japan earthquake. Well, prediction is always a very difficult thing. I think if you look at forecasters, what they can say is that there's going to be an active hurricane season. So last year was an active hurricane season. This year has been predicted to be relatively active as well. The key issue always is whether the hurricanes, which are sort of relatively small in size in terms of where they actually hit, if they hit an area that's got a lot of insurable claims involved. So for us, if something goes into the middle of the desert or stays in the middle of the sea, even though it's a very big hurricane, it doesn't affect our insurance claims. Just a very quick final one. These are essentially bond investments that are triggered by natural events, and your advantage is that at a time where, you know, bonds, equities, real estate, all these things are highly correlated by the overall macroeconomic environment. Your advantage is that you're a little bit more diversified. You don't, you know, the investment doesn't correlate in any ways and influenced by, you know, difficult macro conditions. But does that also mean that you don't have a natural audience? I think we do have a natural audience, because anybody who's looking at building portfolios with diversification in there is always looking at proper sources of income that don't have high correlation to each other. So now a lot of the pension fund consultants are recommending that their investors put 1 to 5, 6% of their gross assets into this kind of non-correlating insurance asset class. There you go. Thanks very much indeed. More potential there for diversification. Thanks very much indeed. John Wells, chairman of Leadenhall Capital Partners. Good to talk to you. Catastrophe risks.